Good afternoon, Good afternoon, everyone, and warm welcome to the post-budget analysis hosted by the Indian-American Chamber of Commerce. Our today's discussion would be centered around the key budget announcements in part towards achieving a Viksit Bharat 2047 vision. With growing focus of Sabka Vikas, Budget 2025 aims to bring transformative reforms in the domain of taxation, power sector, urban development, mining, finance sector, and regulatory reforms. To promote ease of doing business and attract foreign investments, the government has emphasized on various income tax and financial sector reforms. Today, towards this, new income tax bill is proposed to be tabled in the coming week, which is expected to be more simplified version of the existing law. The financial sector reforms would cover overall regulatory framework, fast-track mergers, KYC simplification, FDI regulation, and so on. Besides the above, the proposed reduction in personal tax rates have given big relief to the middle-class taxpayers, which would eventually boost consumption. To weigh in on these proposals in detail, we have our esteemed panel of seasoned experts from various domains to share their valuable insights, specifically focusing on the India-US corridor. Let me introduce Dr. Atul Chauhan, who is the Regional President, IACC, North Indian Council. He is the Chancellor of Amity University and the President of the Amity Foundation. Dr. Chauhan is a member of many government and statutory bodies, including being a distinguished fellow of the Institute of Directors and a member of the Expert Committee of University Grants Commission. Dr. Chauhan sits on many boards, including SOCHM Europe and the Netherlands-Indian Financial Corridor. Dr. Chauhan requests you to share your initial thoughts on the budget and the overall direction the Indian economy is expected to take over the next 5 to 6 years, or 5 to 10 years.
Thank you so much, Akhil. As the regional president of the Indo-American Chamber of Commerce, North India region, it is a great honor and delight to welcome all the participants and panelists for this session, which has become a landmark annual session, which is looked forward to. And I'm very happy to be informed that over 500 people from the industry have registered listen online today. We are extremely honored and glad to have as the chief guest today, Mr. Raman Chopra, Joint Secretary TPL in the Central Board of Direct Taxes, Department of Revenue, the Ministry of Finance. Mr. Chopra, we know how much stakeholder interaction there is, and we are delighted that the government interacts so much with all stakeholders before coming out with the budget. And you have spent many days and nights, I'm sure sleepless nights, working extremely hard to reach the stage that we have reached today. And we are extremely grateful that you are here today to share your valuable insights. We know that your time is tight, so I will not go and introduce the extremely distinguished panel of speakers that we will have today with you, but just a few words. We believe the budget 2025, a visionary budget delivered historically for the 8th time by the Honorable Finance Minister, delivers a comprehensive vision for India's future. It focuses not only on driving economic growth, but also in ensuring that this growth is inclusive and sustainable. From infrastructure development to green energy, taxation reforms to social welfare, this budget sets the stage for a stronger, more resilient economy. As the Indo-American Chamber of Commerce, we recognize the potential of these initiatives to strengthen Indo-American economic engagement. We remain committed to collaborating with stakeholders to harness the opportunities presented by this budget, fostering growth and prosperity for both nations. I will stop here to give Mr. Chopra more time, but I hand over back to Mr. Akhil Chandna to take forward this session. Thank you, Mr. Chopra, once again. Thank you.
Thanks, Mr. Chauhan, to give your perspective, quite insightful. Let me quickly get Mr. Aseem Chawla, who is a mentor with the BFSI committee and a partner with AS Legal Solicitor and Advocates. He has over 2 decades of experience in advising on a variety of domestic, international tax, business, and legal matters. He's a member of Bar Council of India and fellow chartered accountant. Let me congratulate Mr. Chawla, as he's been recently designated as a senior advocate. So, Mr. Chawla, if you can quickly, give your perspective to it before we goes to Mr. Chopra with specific questions.
Thanks, Akhil, for your very kind introduction. I think we all have our ears for Mr. Chopra. I would rather only put it in one line before we request, and I understand he has a hard stop. So I think two things only, the faith in the middle class and perhaps the larger faith in voluntary tax compliance, as said, trust first and scrutinize later. And of course, all eyes and ears are awaited, and I'd rather take this opportunity to request Mr. Chopra that once the tax bill is tabled, he should give us some time out of his diary for reconvening this in a short span and understand the nuance, as the Honorable Minister has said, that we need something which is commensurate to 21st century. And as a former sort of senior standing counsel for revenue, I am glad to say that the approach suggested by the CBDT is participative and not adversarial. The only sort of curiosity I have as a student of the subject and macroeconomics is the tax buoyancy. When you look at the 24 numbers with 23, where we've had an increase of about 20%, and now with this 1 lakh crore of the great leap of faith, which is rightly said as not as revenue foregone, but as the trust, we are again looking at 14.4% increase in income tax, which will peg a number of about 14 lakh 38,000 crores. So the overall tax buoyancy is something which I'm very curious to hear about. So without much ado, we request Mr. Chopra for his address. Very erudite he is as a personality, and the team has worked very hard on this, and I've had my first-hand interactions pre-budget on behalf of the chamber. I can only say that no stone has been left unturned. Over to Mr. Chopra.
Thank you so much. Thank you so much for the good words. One thing which I reiterate again and again every time I interact with all is that this government is responsive, and it reflects in each and every budget which comes through. In the last so many years, and in the interactions we've had across so many virtual seminars, physical meetings, fundamentally each and every suggestion is weighed, and whichever is critical importance is brought through. In this year also, you see, apart from everything else, the budget proposals are very simple. If you read through the budget proposals, fundamentally there is very little which is uncertain in the proposals, and that is the focus of the government, to develop certainty in respect of tax certainty. The first certainty comes when the proposal itself is certain. Once the proposal is certain, language is okay, you does not raise too many questions. In this year's budget, if you read the proposals, apart from maybe the transfer pricing block, which is a totally new concept, you cannot pose too many questions to me that how will this work or how will this work. Fundamentally, I just attended the FICCI session also. There were not too many questions which were coming up, and that is I consider that as an achievement of the CBDT, that fundamentally we are able to put across something which does not raise too many questions. So on the rationalization front, in fact, you've seen that TDS has been, our focus was clearly to reduce the rates and increase the thresholds so that the money blocked there does not remain blocked. It is good for the government, we do not pay interest. It is good for the taxpayer, it does not result in money blocked, capital being blocked there, working capital being blocked there. We do not want that. It benefits both. And in addition, it results in refunds over the next couple of years. There is no point in having that. As far as possible, we need to have a rational structure on that. On charities, and if you saw that charities was again a very critical amendment there, from 5 years to 10 years, the validity period of the registration has been raised. So that will also improve a lot of reduce compliance burden by almost 50% for 90% of the charitable entities. So that is also a positive step in that context. On especially for the non-resident, the certainty being given in providing services to the manufacturing sector in electronics, that is a special presumptive section which we brought in for that booming section in India, which relates to electronics manufacturing. That is the next area of focus which is going to be, and we are going to have a lot of scope of expansion there. And what we got from the stakeholders was that there was uncertainty when they started giving services in India, especially when they sent over personnel to work here, give training, engage in installation, etc. It would give rise to permanent establishment, supervisory fees, installation fees, which again raises the whole gamut of profit being attributed to this place, and in the end process just resulting in uncertainty and litigation. That has been clearly put to rest. A step has been taken to take a 10%, less than 10%, less than treaty rate of the gross amount of payment to going to the non-resident. So that is actually going to be a very big enabler for the industry here, as well as for the non-resident who's going to come here and give any type of services or technology. So there also a clear indication has been given. For the startup sector, a five-year extension is given. For all IFSC sections, there also you see the certainty aspect of the whole process is absolutely in focus. Earlier, it was being increased by 1 year, 2 years, infrastructure, sovereign bonds, the pension funds coming here in infrastructure sector. Every year, it was being increased by 1 year, 2 year, 1 year, 2 year. That was not helping because nobody comes into or can plan an infrastructure element for a period of, say, just in a period of 2 years. So clear direction for that is that a 5-year extension has been given so that you can actually plan and come here. That is what is wanted for both IPSCA as well as startup as well as infrastructure all across 3. So there have been so many changes which are actually enabling that now you take a call, tax department is going to give you certainty. We will also come up with a fresh safe harbor rules that is also in the pipeline. On almost all aspects, the trust aspect which Akhil was raising, that updated return has been a huge success for up to 2 years. That has been extended to 4 years now, albeit with some additional amount of tax, but that is required because I have to be fair for the person who comes early and comes late and chooses not to come for 3 years. So that also is actually trusting the taxpayer more. Again, the basic message of the FM that we need to trust the taxpayer. Let him come on a voluntary compliance basis. So once he comes on a voluntary compliance issue, then we are okay with it. We do not want to litigate it. It is a non-litigated solution. On all those aspects, we are doing good. That is how I place it. On the second part of the FM statement was what is going to come with the new bill. That being a parliamentary privilege, I at this point of time cannot share, unfortunately, cannot share what is going to come here. But she's already spoken twice, thrice on this subject, and she's clearly elucidated that it is going to be concise, clearer, easier sections, and easier language, direct language. She's already spoken on that. So that is how it is going to build up, and that is what she stated in her July budget. And we've been working tirelessly. The board has been working tirelessly towards that. We see how it develops. So I can stop here. I can wait for questions for about 5 minutes or so. And any critical questions you have, I'll just take them.
Thank you, Mr. Chopra. I think as you rightly said, the government has put across a theme of self-accountability, certainty, simplicity. I think it's a balanced approach which government has followed on simplicity, inclusivity, and sustainability while fostering for economic growth. I think I have few questions. I think you simply put everything together, whatever are the key announcements and all. But I think there's been lot of focus on GCC, Global Capability Center, being set up in India. As per the reports, India will have 2,000 GCC with a market value of over 100 billion USD by 2030. And even, the finance minister has announced that a national framework will be formulated as guidance to the states for promoting GCC in emerging tier 2 cities, which would focus on talent, availability, infrastructure upgrades, and industry collaboration. I think the people at large would like to understand if any tax incentives are being planned in this context, as nothing in this regard has been mentioned in the budget.
In that context, I can tell you that maybe once the whole process comes into picture and starts taking shape, then the tax incentive is actually not a secondary part, a subsequent part of the whole plan. once you try to set up a GCC, what you require, what type of tax incentive you require, whether you require certainty in the form of a safe harbor or a presumptive tax or an exclusion or an exemption or a deduction for a period of time. That is how we have to see it. At this point of time, as far as in the present year's discussions, it was not very clear from the other side that what do they want. Yes, we want to promote GCCs, but on the tax front, what do they want was not absolutely in black and white at this stage.
Mr. Chopra, I have one question with regard to the backlog of the appeals with the first appellate authority. Is there a conscious effort or some deliberate intervention being done to see that the backlog is taken care of? I understand the joint commissioners have also been empowered in small cause matters, if we can put it in that sense. But is there a deliberate mechanism which is being thought to take care of that backlog?
I think if you go from the current year's disposal, they will be substantially higher.
Okay.
They will be substantially higher when you get the figures on 31st of March. That is how I view it.
Okay.
Because there were a lot of cases which were of the type of non-appearance cases.
Yeah.
In the additions, in the faceless, maybe in the initial part of faceless, they were not even aware that where to respond, how to respond, where is the notice coming. So if you took the July budget, we had introduced a specific amendment that CIT appeal was also empowered to set aside cases which were passed ex parte.
Yes.
So once that proposal is there, it naturally there is a faster disposal and not going into the merits of the case of a case which has not been heard in the first place itself. So that will involve a better disposal from their end, the demand going off our books, demand going off assessee's books, then going back to the assessing officer and then being recomputed again after responses from the assessee. So that will dispose of. Plus, it is being continuously monitored by the A&J division and the chairman and the member A&J that disposal has to be good.
Okay.
So
just one follow on, since we represent the larger cause of Indo-US trade and US is one of the larger trading partners. I mean, is there a deliberate view after the BAR has been set up post abolition of AAR that BAR's pending applications also are expedited, and therefore that element of certainty which you have really spoken about is given to an applicant who wishes to approach to a BAR to get a certainty in terms of a ruling. Is that something also being looked at?
Absolutely, yes. A strong yes on that. In fact, the BARs were getting back to the tax policy legislation division that people are not coming forth. What do we do with those representations or those applications? In fact, there is a jet lag due to that also, because people are not coming up. It's fixed, then he's not coming, then the time is wasted, the hearing is wasted. So something has to be done to those applications also. That is also on the table. That we need to set aside, just let bygones be bygones and proceed with the new ones. That's how it is to develop. Yes.
That's an optimistic way of looking forward.
Yeah. You have to
Dr. Chauhan, do you have any question or any area which you feel is relevant for industry point of view, you being our leader along with Arun,
Right. I will, if Arunji is there, I will let him ask. And then, but of course, for education, a lot has been done. But I think there are concerns with the zero value of GST, which I think we will take forward as a chamber with Mr. Chopra at a later point of time. I think a lot can be done in that area to support the not-for-profit education sector in our country.
Thank you, Dr. Chauhan and Ramanji. The GCC's topic did come up, and it is quite interesting and quite relevant as well, because most of the GCC activity in India is dominated by US companies thus far, establishing their captive centers in India. And I think in that direction, the streamlining of the international taxation and expansion of safe harbor rules will go a long way in accelerating the boom in the sector. And I think also the announcement in the budget with respect to the transfer pricing process, adopting a block period approach of 3 years for arm's length tax pricing. I think this will provide, like you said, far greater certainty in this space and hopefully attract more investments in the GCC space in India, simply because of that certainty factor going up. So thank you for your comments as well in that sector. Thank you so much.
And on the transfer pricing thing, actually, it is resulting in a year-on-year repetitive same exercise, compliance burden
Correct.
for you, compliance burden for us. It is not only for the assessee we are doing it. Let us be very clear. Because administratively, we are doing the TPO doing the same TP exercise for every year absolutely does not result in anything positive. So that is why it has been seen through in that manner that once a TP audit is going on, during that process of audit, since we have time available and 2 financial years are already concluded before that TP audit ends. So why not let the assessee take an option that please apply my ALP to these similar transactions also. And we will be prescribing conditions on how the TPO will first decide on similarity and how we will subsequently include it in the TP order for the subsequent 2 years, and the AO does not take it up in scrutiny for subsequent 2 years. There also in subsection 1, we've clearly mentioned, even if a reference is made, it will deem not to be a reference for the subsequent year. So you get a clear closure in respect of similar transactions for 3 years. I think that is going to provide a lot of certainty. And for
Absolutely.
for the GCC thing, yes, I again say that it is the safe harbor route which is needed for such companies, because activities you have to point out, and then you only have to tell us that what is the adequate amount of profit which is arising to you. I cannot judge. You are the best judge for that. And if it is fair for the department, we will incorporate it in the rules. That is how I look at it.
So I understand. Thank you so much, Raman.
Mr. Chopra, I think one question I just quickly take. I know we've already exceeded the time limit you have. I think it's people want to hear more on carry forward of losses in case of amalgamation. The vision states that evergreening of the losses will not be permitted for any scheme of amalgamation which is brought into force on or after 1st April 2025. This was announced. So there's a confusion which people want to get clarity on, that whether this provision will be applicable for the cases already filed before NCLT, but the appointment date has not been given, or would this apply to a new schemes to be filed on before NCLT on and after 1st April?
We will give a clarity on that. We do not intend to apply it retrospectively to any actions which have been already initiated. That is my personal view at this point of time, but we will certainly give clarity on that. There is no intention of any retrospective amalgamation. That is why it's been put on statute like that.
Got it. Thanks a lot, Mr. Chopra, for your time.
Thanks a lot.
And as always, please, you've been so generous. We are full of gratitude that you always come, give your time in such a busy time, and share your thoughts and how that's a way to reflect that government is very welcoming on any suggestion, and on self accountability. You said that the government has listened to everyone and always come out with things which are more simpler, clearer. And now everyone sitting in this room is expecting, even the audience listening to this, expecting a lot on 6th of February when the new bill will be put on the table. Thank you.
Thank you so much.
Thank you, sir.
Thank you.
Take care.
Thank you, sir.
So let me go back to Mr. Chawla. There are 2-3 things, which we wanted to ask Mr. Chopra, but let me ask, and put that across to Mr. Chawla. So I think what, according to you, are the key highlights for the BFSI sector, Mr. Chawla, if you want to just, put some emphasis on that.
I think the announcement with regard to the 100% FDI on the insurance largely takes the attention of everybody. I think it's the highlight of the I is the highlight of BFSI. And as far as the financial services is concerned and banking is concerned, I understand that we have an expert from HSBC who's going to cover markets, and I'm very interested to know what his thoughts are, especially considering the Trump announcements today morning only with regard to China, Mexico, and Canada on the tariffs and the impact on the monetary policy and the rupee FX rate, since I understand he's an expert on that count. So look, insurance is too late and too late, but hopefully not too little. We have 70 insurance companies in India, and you have a population of about 1.4 billion. The way we've been inclusive, or at least have tried to be inclusive on banking as compared to 20 years ago with Jam, Trinity. I think this will give an opportunity for the existing players to look at their JVs, and therefore perhaps more business for consulting firms likes of GT. I understand Allianz, the French major, is already looking at negotiating its JV with Bajaj. That's publicly announced, so I don't have any privileged info on that. The only thing I can tell you, being coincidentally being a former director appointed by the government on the board of one of the largest state-owned insurance companies, I was the co-chair of the audit committee also. I can tell you that India needs to be an inclusive society insofar as insurance is concerned, considering that majority of Indians do not have social security and are not part of organized employment. So therefore, health and the cost of health improving or sort of escalating. It's by no means we can afford to have a society which is under or not insured, considering that we are the largest population, we are the diabetes capital or the diabetic highest in terms of cancer. So, I mean, there are 3 or 4 parameters which are very alarming in terms of the overall health of the Indians, not health of the Indian economy. So if you look at only 70 insurance companies in India, I think this 100% will attract about $12 billion of FDI. So that's about it. On banking, I think there's a fair bit already done. Bankers now are recalibrating their strategies in India with regard to their retail presence. If you're looking at the foreign banks, the SBI consolidation, I think, has worked very well. The last 2-3 years of consolidation of nationalized banks into large, big banks, so to speak, has also done well. Now is the time for India, and after this, I really see no reason for the global majors or the big producers, as we call them technically, not to figure out India as a attractive market. So that's one question on BFSI. Yeah.
I think there was some technical problem for which my laptop got dropped. I'm audible.
Yeah.
Yes,
Any
Akhil.
other question you have, Akhil?
I'm audible to everyone.
Yes,
Yeah,
Akhil.
yeah.
There was some technical problem because of which my laptop got restarted. I've just changed it to this one. Uh, Thanks, Mr. Chawla. I think uh, you've clearly laid down, and I missed on the last one or two statements from your side. Uh, but you clearly put the perspective and the need of the hour, and that's why these changes, whatever government has done in this budget, are very welcoming. Now move to my second question is Jan Vishwas Act 2023, which was introduced in Finance Act 2023. It talked about decriminalization of more than 180 legal provisions. Now the government has proposed to bring Jan Vishwas Bill 2.0 to decriminalize more than 100 provisions in various laws. Uh, we request you to enlighten us whether this will have a positive impact on attracting overseas investors and compliance companies to India.
Sure, indeed. I mean, business should be seen doing business, not defending lawsuits in courtrooms, especially for technical infractions and violations of law purely on technical interpretations. I mean, a business is ready to pay interest for any delay. Maybe it's ready to look at issues of compounding, and therefore the very recent compounding guidelines issued by Tax Department on 17th of October in furtherance of their guidelines of 16 September 2022 and earlier 14 July 2019 is a welcome step. And if you tell a business that, look, there's something wrong which has happened, there's a bit of fine or penalty or compounding, they're more than happy to pay about it, because paying for litigation, which is zero-sum game at the end of the day, doesn't hold good. So, in fact, when the new compounding guidelines came in, and I remember espousing the cause of revenue, we only did offer that to, in the sense that alluded or drew attention to the taxpayers that look, there is something which you could consider. So I hope the new tax bill does take into consideration that the technical infirmities leading to prosecution are put at bay only in situations of an exception, not as a norm, so to speak. So it's a very welcome thing, and the tapering off of these provisions, if they happen sooner, the better it is. I think it's a continued step in right direction. You take a step, you hold it there, but the sheer fact that this budget, if you look at, a lot of references were made to the earlier budget, did suggest that everything is work in progress. They haven't announced, stopped, made new announcements, then stopped, and new announcement. So the reference in point to the earlier provisions, I think, was very welcome.
No, I think very, very clearly laid down, and as you said, it's a very welcoming step. The industry at large will take this in a positive way, and it will improve our ease of doing business. And I'll come back to you, Mr. Chawla. But now quickly, let me go to our next panelist and our guest, Siddhartha Nigam, who's a partner and US corridor leader at Grant Thornton, Bharat. So let me give a quick introduction about him. Mr. Nigam comes with more than 25 years of experience in investment banking and strategic consulting across India and UK. During his career, he has worked across a range of transactions, including M&A, private equity, IPOs, project finance, debt, syndications, and distressed situations. And I'm very happy and glad to have him on our panel today. So, Mr. Nigam, as you know, this year's economic survey clearly laid down the path to achieve the vision of Viksit Bharat 2047. To achieve the status of developed nation, it's clearly said that India must sustain 8% annual growth for the next couple of decades, as well as raising an investment ratio to 35% of GDP, for which we understand that India needs to create 78.5 lakhs jobs annually till 2030, continues to invest in emerging technologies like AI and biotechnology, and focus on MSME as well as have more structural reforms. Do you think the government has in the current budget laid down the path towards moving in this direction, specifically with respect to MSME, exports and investments, which have been identified as growth engines towards achieving the vision of Viksit Bharat 2047? Your views on this, sir.
Thanks, Akhil. Thanks for having me on this panel and with this esteemed speakers. I think I'm not an economist. I'm coming from more from a perspective of somebody who works extensively with the private sector, or both domestically and internationally. I think the budget, in my view, was a very nicely strung necklace with parts that we saw in the budget speech, which was actually very succinct and crisp this year, and a lot to follow, as Mr. Chopra also alluded to, that this was, I would not call it a trailer, but there is a lot of detail that will follow. Very progressive, I think, very clearly pushing the reform agenda forward, which is around ease of doing business, attracting more investment, creating jobs. So the tone has remained the same. And I think there is a lot more, I would say, action-oriented steps around that, specifically around MSMEs and the growth chart that we have put forward for ourselves as a nation. The MSMEs, or middle market, as I would like to call them, if that is okay, have to become the, I would say, the growth engine for the economy going forward. I mean, if I was to compare that to really Germany, where their mid market is called Mittelstand, it is actually really what the entire German economy is forged on. I think the government's progressive agenda to help enhance our MSME sector through very specific targeted initiatives such as credit guarantee cover, fund of fund for startups, credit card for micro enterprises, first-time entrepreneur schemes, but also, a lot of the interventions or mentioned in the budget about the manufacturing sector, whether it's the national manufacturing mission, clean tech, the benefits to the clean tech industry, specifically calling out toys and leather and footwear, or from an export standpoint. I think both from a domestic consumption as well as from an export growth perspective, the MSME sector is going to play a critical part. I think the budget addressed a lot of things that will help them propel forward, but I think there's a lot more that is yet to be seen. Things around PLI and other specific incentives. I think Akhil, you asked Mr. Chopra a question around that. So linking the growth of manufacturing, which will help in employment creation, to powering exports, I think the budget did address that quite adequately.
I think that's the best way to summarize the entire speech or the entire budget in simpler words. And few key takeaways. It's very progressive, and the new name which you've given is a middle market, which considered as a growth engine and domestic consumption. Now coming to my next question, as well, how this will impact the India-US corridor and India's position as an attractive investment destination overall.
I think there was the big trump card to me in the budget was the fiscal consolidation, to actually say that the fiscal deficit is better than forecast, and there'll be a reduction next year. I think this should lead to an improvement in the credit rating of the nation, which in turn should attract a lot of foreign investment, which we need for our growth. US will, as traditionally, will be the largest part of that. So I think that will only enhance the flow in of capital from the US, or I would call it private capital. Also from a export standpoint, the US is one of the largest markets for India, but also certain sectors which have been open, insurance that Mr. Chawla talked about earlier, as well as nuclear energy. I think those are the two sectors which will see hopefully a lot of collaboration with US companies for technology, for capital, etc. I think on a geopolitical basis, I think where the world is, I think the Indian-US ties, I personally believe, will get stronger, given the two democracies and a secular way of growth that both the countries have look at each other. The importance of Indian diaspora in the US, as we see a lot of the Trump administration has a lot of people of Indian origin. The whole focus of GCCs, which were mentioned partially, and I think there's a lot of excitement around that. Akhil, if I may, I think just a very small example relates to Thornton, Bharat, where we have opened our own GCC in Dehradun, a tier 2 city, and we've seen the benefit of going and taking jobs to the people. I think this is again a very progressive step to enhance the setting up of GCC in tier 2 cities. But I think, as I said, there is the detail is yet to follow. In summary, I think US India will continue to be very big trading partners. I think they will both benefit from this relationship to be strong at a political level, at a trade level, and also at a people-to-people level.
I think Sid, not Dehradun, now Indore as well. So we've extended to another tier 2 city, and you rightly said, then the importance of this India-US relationship is something which everyone is looking forward. And now taking your conversation ahead to Mr. Arun Karna, who's our executive council member at IACC and a managing director and CEO at AT&T Global Network Services India Private Limited. He comes with a 34 years of experience in telecom and IT industry. Let me get him also along with you to ask his perspective, and specifically from a US industry, because he's our ex president at North Indian Council IACC Chamber, and continuously being a part of a lot of committees like B20 Task Force on Technology Innovation, Research and Development. He's a core member of CI Delhi State Tech Panel. So your views, and maybe we can go back to Mr. Sid, or both of you can throw more light on this.
Thank you so much, Akhil, for that warm introduction. And let me begin by saying that I couldn't agree more with what Mr. Siddhartha Nigam has just said, and I'll try and add some to it. But first of all, let me say that as we reflect on India's Union Budget 2025, it is crucial to examine its implication, not just for the Indian economy, but for also the US businesses, investors, and the larger Indo-American Economic Partnership, which I would say is the most consequential or one of the most consequential bilateral relationships in the world. This year, our discussions carry even greater significance as we analyze not just the impact of the Indian Union budget, but also how it aligns with the priorities of the new US administration. So, as we know, there are quite a few angles that are emerging to it. As we stand at the crossroads of a new economic era, uh, like Mr. Nigam said, the Indo-US partnership is more important than ever. The current budget, coupled with the new leadership in Washington, presents us with both opportunities as well as responsibilities to shape the future of our bilateral trade, investment, and strategic cooperation. Our budget reflects our vision for sustained economic growth, self-reliance, and deeper global integration overall. The US, under its new administration, has also reaffirmed its commitment to strengthening economic ties with India, recognizing our nation as a key partner in a rapidly evolving global landscape. Let me touch upon three broad areas or key areas where I believe this budget will shape the Indo-US trade ties. And some of these aspects have already been touched upon by the esteemed speakers that came before me. So first, in the area of trade and investment reforms, I think a new era is about to begin in this area. The budget has introduced incentives for FDI in high-tech manufacturing, infrastructure, clean energy. These are areas where US companies are leading global innovation. We've already talked about the hike in FDI insurance going all the way to 100%, which will surely pave the way for US insurance giants to bring in substantial foreign investments in the Indian insurance market. Yes, but also the collateral effect of this would be to bring in more sophisticated risk management, advanced technology, and maybe more innovative products in the Indian insurance market. We've already talked about the GCCs and their streamlining the international taxation and expansion of safe harbor rules in India will accelerate growth. This is a booming sector, like you said, Akhil. This is slated to hit about $100 billion by the year 2030. And most of it is currently dominated by US companies setting up their captive centers in India, including our own company, AT&T. So here, like Mr. Raman said, the transfer pricing process, where there has been a budget announcement of adopting a block period approach of 3 years, that brings in a lot of certainty, and certainty is liked by business, and therefore this part should grow even more exponentially. Then in the area of technology and digital economy, I think there'll be a further strengthening of US-India collaboration in various areas. The budget earmarks allocations for artificial intelligence, quantum computing, cybersecurity. This will pave the way for JVs between India startups and the US tech firms. I think there will also be further strengthening of the ongoing cooperation in what we call dual use technologies. These are technologies that can be used for both defense and commercial purposes. And again, there should be acceleration in partnership in the areas of data centers, space, satellite communications, geospatial technologies. All of these should go hand in hand, and they will grow, and there will be increased partnership between US and India on these counts. In the area of energy and sustainability, which was also touched upon earlier, we see a shared vision for a green future is emerging, regardless of some of the rhetoric. There is some bit of rhetoric on this count, but I think there is a shared vision here between the two countries. Our budget lays out very ambitious renewable energy policies, including new incentives for solar, hydrogen, and battery storage technologies, which will directly benefit some of the US companies which are specializing in clean energy solutions and sustainable technologies. And this will accelerate the partnerships in these globally critical areas. India's commitment to energy security is highlighted by the announcement of the Nuclear Energy Mission for Small Modular Reactors, or SMRs, with an outlay of INR 20,000 crores. Likewise, the National Manufacturing Mission with its focus on solar PV cells, EV batteries, motors and controllers, electrolyzers, wind turbines, and high voltage transmission equipment, this will attract significant investments and tech partnerships between Indian and US companies. I would say the budget is yet another step towards achieving the vision of Viksit Bharat by 2047. And what does it really mean in real terms? As per IMF, our per capita income currently is US dollars 2,697. The IMF benchmark for a developed countries per capita income, is US dollars 23,380. Now, for this to be achieved, the Indian economy will have to grow at a sustained growth of, someone is saying 7.6% per annum, some people are saying 8% per annum for the next 2 decades or so. And this would need strong global partnerships with strategic partners like the US, amongst other things. I would say this budget delivers a clear message that India is open for business, India is open for partnerships and for shared innovation. And I would say we at the Indo-American Chamber of Commerce, our role is to foster these opportunities by strengthening bilateral ties, facilitating business dialogues, and ensuring that this momentum translates into concrete partnerships. And at the end of the day, as we analyze all the aspects of the budget, we must recognize that the Indo-US partnership is not just about numbers and policies. It is also about a shared vision for prosperity, innovation, and sustainability. So, Akhil, those are my thoughts on the subject.
I think very insightful, Mr. Karna. And I really like your analysis on per capita income, how we are positioned today, and if you want to become a developed economy by 2047, the kind of growth we are looking for, the kind of journey we are looking for, and how our government this time has given this path, announcing that we are very open, and the focus is on structural reforms, deregularization, which is one of the theme coming from the economic survey clearly. I think more key takeaways, and the kind of progressive statements which you have given, Mr. Nigam has given on the entire India-US partnership, and the entire corridor, and in spite of there's a lot going in the world, there's a geopolitical issues and tension across, but still we feel that this relation is critical, and this will progress in the right way. So I know you and Mr. Nigam both have a hard close. So thank you very much for sharing your thoughts. Any concluding statement, Mr. Nigam, by you, and after that by Mr. Karna, before we go to the other panelists?
I would just say that this is a step in the right direction as far as budget is concerned, and I think it's a bigger step as far as India-US relationship is concerned. There is a lot more I predict that will happen on the corridor in various ways and forms. We just need to be a little more prepared. I think the only part I would say, the budget did obviously allude to some tariff cuts, which is like an olive branch to help expedite the benefit that I think as a nation will derive from our Indo-US relationship.
Thanks, Mr. Nigam. Mr. Karna, any concluding remarks by you?
No, I agree with what Mr. Siddhartha Nigam has said, and like you also said, the Indo-US partnership is a long enduring partnership. There are existing bilateral agreements which are foundational to the relationship. Those stay strong, and there's all to look forward to in the coming times. So thank you.
Thank you. So let me go to Mr. Gaurav Sehgal now, because we've been discussing on. I know we kept him for the last, but it's important for him to come now. He's a director of market and security service at HSBC. He leads the global market sales team for North and East India region. He has about 17 years of experience in global markets, in managing both global banking and corporate clients. So thanks, Mr. Sehgal, to accept our invitation and here to talk more on the financial markets and for investors. So my first question to you, I think in the recent past we have seen the foreign investors repatriating their funds out of India. In the current budget, the government has announced to review and simplify the existing conditions associated with foreign investments. Do you think this move by the government will attract more foreign investments back to India and bring more stability?
Thank you, Akhil, and thank you everyone for joining in, and thank you for inviting me. And very interesting to hear comments from all the speakers till now. So I think from an overall perspective, what has happened over the last 6 odd months is that there has been a bit of slowdown in Indian GDP post the elections, and there was some cut in capex spending, which had actually led to some slowdown in GDP. What had also happened over the last 1 year or so was that inflation in US was high, and which meant that the US Fed had been hiking interest rates, and the US rates went higher. So that meant that the risk-free returns that the US investors were getting, or the investors were getting in US, had gone up to as high as 4.5%, 5%. The US 10-year actually touched 5% return, which meant that if an emerging market was to offer returns with its associated risks, it should have been higher. So we did see slowdown in FDI. During the COVID times, FDI into the country had gone up significantly. But post US rates going up, the investors seeking higher returns had actually slowed down investments into through FDI into the country. And that also coincided with the last 6 months of GDP slowdown, which the prints which came in. So what we've actually also seen is outflows from equity markets by FIIs since October of upwards of $20 billion. So it's been a cocktail of many things, with US rates going up and the new administration expected to come in and put in some tariffs, which also meant that if US was to put tariffs, which it would have meant that inflation in US will continue to stay high. And market, which was projecting that US interest rates will go much lower from where they are, actually started pricing in lesser cuts from the US Fed. So it's actually two sides of the equation. The money is going out because US interest rates are actually more attractive. And also there was a slowdown in GDP in India. And that meant that the valuations here were slightly not attractive for investors. But having said that, I think a lot has happened over that. And rupee has also depreciated from levels of around 83 to 87 levels. And there has been a change in guard at the central bank in India as well. So we do feel that given the overall macro stability that the budget has offered in terms of the fiscal deficit number being curtailed to 4.4%, and government promising by 2031 that they will take the debt to GDP to 50% for India, that will lend stability to the overall macro of the country and give investors confidence. What also happened last year that Indian bonds were included in global bond indexes, and that meant some flow coming into the Indian rupee bonds, the government bonds, and that also helped kind of FII flows into Indian debt as well. But remains to be seen how world shapes up going forward, and how the US administration takes steps going forward.
So, Mr. Sehgal, I think rightly said, U.S. interest rate is one of the major reason, GDP going down, which means there's a tight liquidity which people have faced, rupee depreciating, which you've talked about. And I think two more factors which I was reading somewhere is one, weak corporate earnings, because corporate earnings have not been great in the last few quarters, and even the capex allocation, which has led to this, equity market impact big time in India. However, there are some measures which RBI is taking on those sides, whether it's an open market operation, 60,000 crores government security purchase to inject liquidity, then 56-day variable rate repo, which talked about, and USD INR swap, like $5 million for the next 6 months to stabilize rupee and manage forex reserves and all. So is this true? You want to highlight something on those measures, whether this will actually bring back our equity market? Or obviously the corporate earnings has to improvise. There are other factors which needs to be, worked upon as well. But just wanted to have your thoughts on this.
No, sure. You're absolutely right that the corporate earnings did slow down, and that was actually an aftermath of GDP slowing down. During election times, of course, the capex that government approves and does get impacted. So government had actually budgeted for 11 lakh crores of capex for FY25, which is actually the revised estimate is actually 10 lakh crores odd. So that means they have actually spent less than what they had budgeted, which has also meant that the fiscal deficit that has come out for this year is lower than what was estimated. So as a result of that, this capex cycle, it is slower than what it was expected to be. You're absolutely right in the sense that RBI has started taking measure to infuse liquidity. So what happens, Akhil, is that when currency is depreciating, the central bank goes in and tries to intervene in the market to curb volatility so that the market operates in a non-volatile manner. So when RBI sells dollars in the market, they suck out rupee liquidity by giving those dollars in the market. What that meant was that the liquidity in the system did get reduced. Now, RBI has announced a few steps which have meant, including a CRR cut the last time, which will mean that liquidity will start flowing a bit more into the system. We also think that given the government has promised fiscal consolidation and even going into 2031, this will mean that this can give a lot more confidence to RBI to start cutting rates. So in the next policy, which is on 7th, we do think that we will see at least a 25 basis point cut in Indian rupee interest rates, which will, so I think government has done their bit in giving confidence to the central bank. Some heavy lifting for growth will have to be done by the central bank as well.
Thank you. Thank you. I think it's very insightful. And now my last question to you, that in the recent past, you've seen there has been extreme volatility in the INR post Mr. Trump's election and the rupee depreciating and all. What do you think on the same post budget in the overall context, whether, and we've heard our industry experts, especially the people who've been focusing on, US industry, and they're very positive and they've given a lot of, assurance that, these short-term hiccups will never impact our long-term association with India, US, and everything. So what's your take on this?
So I think what we saw was 2023 and 24 was very, very non-volatile from a INR perspective. We didn't see volatility at all. Actually, we used to come to office and we used to see 2-3 paisa moves in a day. So that's the kind of moves we saw. But that was kind of unsustainable in our view because there is a differential in inflation and interest rates of two countries, and a currency is two sides of the equation. One is dollar and the other is rupee. What has happened after Mr. Trump's election is that most of the emerging market currencies have faced this pressure. Dollar index, which is a basket of currencies which it trades against, it has actually gone up from 102 levels to 110. So this move is actually not a rupee only move. It is actually a dollar strength move which has happened. What we saw even today was that rupee has actually gone to 87.20 levels after closing around 86.50, 86.60 levels. This is in the aftermath of tariffs that were announced over the weekend, where China has been put tariff of 10% and Canada and Mexico 25%. It remains to be seen what happens with them going forward, whether this is a negotiating tactic or they will stay in force. But it does stabilize any uncertainty, destabilize the overall functioning of the market. And when investors are uncertain, they try to go into US securities, which is the US treasuries. They are considered as safe haven. So that has definitely impacted rupee a bit. What we feel is, given that RBI has been intervening in this way up and our reserves have actually gone down significantly from their top levels of about $700 billion to right now net, including rupee forward positions, of about $560 billion. RBI will be more okay with a slightly more floating currency, and they might not intervene in terms of actually protecting any levels, but they will definitely be there to curb volatility. So I think rupee will not remain outside of what is happening in the overall world. Rupee is not an export oriented kind of currency like Chinese renminbi is, where exports are a big part. Of course, exports are a big part of our GDP in some way. But having said that, I think it is not more going to be a dollar phenomenon rather than the rupee going forward. So if dollar does depreciate going forward, in case there is some sort of settlement from a trade perspective between the countries, then we will also see some appreciation, but not too much appreciation, because RBI will also try to build reserves if it starts appreciating a bit, given they have lost some.
I think that's quite an insightful, perspective you've given to our audience today. Let me go back to Mr. Chawla. I think he has a few things. He's on the panel still, to check and ask, especially from you when he's talking about, he gave some expectations. So, Mr. Chawla, I hope your questions are answered, or do you want any more information from our expert Gaurav Sehgal here to elaborate on?
I think Akhil, Mr. Chawla is not there.
Okay.
If you don't mind, can I just ask one quick question?
Yeah, Amit, go ahead, please. Thank you.
So, Gaurav, thanks a lot. This is Amit. I run AKM Global. Just out of curiosity, since a lot of us also send out remittances, do you think that with this tariff threat by President Trump, India, along with other emerging markets, would let their currencies depreciate to help their exporters? The reason I'm asking this is that in this budget speech also, the Honorable Finance Minister very clearly said that export is one of the pillars of this budget, and they really want to incentivize. So I see, again, if we reduce interest rate, it obviously puts a pressure on rupee, right? Is all of this, would they let it sink to a level to offset the pressure on the exporters? I mean, I'm not looking really for answer, nobody can predict, but what is your sense out of it, that how is this tariff war going to play out for the Indian rupee as well as for the entire emerging market basket of currencies?
No, surely I think they are more comfortable. Central bank is much more comfortable with slightly more floating on the rupee. I don't think they want to stand in front of a large wave of money going out of the country and trying to say subsidize them by providing cheap dollars. So I don't think so. I think overall it will be a relative move. If in case dollar is going up, then INR will depreciate as well. I think exports has always been a focus of this government as well as central bank. I don't think that focus has ever gone away. But having said that, there is a lot of relative sense here. So if another currency, which is our competing currency, is depreciating, and we try to sort of on a real effective exchange rate try to keep rupee overvalued, that's also not a good thing. So when a currency moves, it automatically does rebalance the economy as well. So whatever slowdown comes and currency depreciates, there is some rebalancing that the currency move does provide. I think your question on other emerging market currencies, I think it remains to be seen, because say Mexico hit by 25% tariffs, it's quite a big one for them, because they do export a lot into US as well as Canada. So we need to see how long or how these tariffs do pan out, because for Canada, it's a country which is small, very small as compared to US, right? So it does impact them in a big way. So I think it might be just a negotiating tactic. We'll have to see how it pans out with the US administration, whether there are any rollbacks or not. But having said that, we will remain a kind of a market performing currency rather than an overperforming currency. So yeah, that's the basic view, Amit.
I think probably I know I agree. It's just that obviously we should ideally move in tandem, but these tariffs, I think if they are on a negotiating tactic, even then I think there'll be some kind of tariffs where they will eventually settle in. It's not going to go away. At least
Correct.
that's my sense. And a lot of these countries might slip into recession also. I think there are already talks of these kind of punitive tariffs might do that.
So I think markets generally move ahead of time. They would have already priced in some sense that there will be some stabilization at a certain level and not go to zero. So markets generally end up pricing these things ahead of time. Rupee has also moved from 83 levels to 87.5. The Chinese renminbi, which was trading around 7, is around 730. So a 4% move has actually already happened post the election of Mr. Trump. So in some sense, some pricing is already done as well in the market.
Thanks, Mr. Sehgal. I think now, as Amit has already, and we've kept our best, part of our discussion, as in the budget. Our finance minister also picked DT at the last, this time around. So audience has been waiting for especially the middleman, because they're waiting for what the government has come out with an announcement which gives a lot of liquidity and domestic push and domestic consumption, because of that money which is going in the hands of the middle class taxpayers. So let me start with Amit. We have Amit and Richa, two are tax experts, to talk about this. And though we have heard Mr. Chopra, Mr. Aseem already, but we have Amit and Richa to talk more in detail. So Amit Maheshwari is a tax partner at AKM Global. He's already introduced himself. He comes with more than 17 years of experience in international taxation. He advises clients spread across industries on the tax treatment of both domestic and cross-border transactions. He has deep expertise in bringing tax efficient solution in M&A transactions, tax structuring, and repatriation planning. And that's why he's been very curious and asking a lot of questions to Mr. Sehgal on that. So that was on a lighter side. But let me go to my first question to Amit. Amit, the finance minister has proposed the introduction of block transfer pricing assessment. I think there's a lot we discuss about. Even Mr. Chopra said that this is very unique and new concept, which none of the tax authorities in the world have ever thought about it, and some unique proposition which they've come out, according to which the ALP for transactions for following 2 consecutive years will be based on the ALP determined by the ALP's arm length pricing. Sorry, I've just used the abbreviation for similar transactions financially under assessment. So what kind of entities do you think might go for this kind of multi-year ALP determination? And you agree with what Mr. Chopra said? It's a very unique proposition, and industry at large will adopt this.
Sure. Thanks, Akhil, and thanks to the Indian American Chamber for giving us this opportunity. Akhil, before I start, I just wanted to make a small correction. The reason I asked Gaurav was not because of the clients, because obviously the exporters are happy. People bringing in FDI are happy. Their dollars buy more of Indian labor and machinery. I think it's people like us who are sending money for children education and others who are more concerned. And that's why I asked Gaurav that might as well send it in this financial year before it touches 100. So I think it was from that perspective.
No, I agree with you. That's why I said on a lighter note. But I think government has given you a relief if you're sending the dollars for your children's education big time. There's no TCS now.
I know. But the problem is if they're well in advance, later in life, then you send it for investments, right? And that's when you get hit by this 20%. But anyways, nevertheless, thanks a lot. And to answer the question, Akhil, I think in transfer pricing, what we have seen is that there was, when India introduced transfer pricing, there was a lot of litigation. We had record number of cases. With APA coming in, it went down. Safe harbor really never picked up because of the high rates and obviously not being at exactly arm's length. So I think the assessments, we have still got a bit of certainty in terms of tax assessments, at least for big corporates who have gone through APAs. But for small and medium multinationals, I think there's still a problem. And what the finance minister has said, she mentioned how repeatedly, year after year, you get hit by the same issues, and there doesn't seem to be an end in sight. I think this concept looks interesting, but there are a lot of questions around it. Specifically, can you really opt out? If you only excise in 1 year, what happens in the next year if you did not probably foresee that your assumptions might change. You might have new service lines coming in. Having said that, I think companies, industries which have very static business model, which have probably single or a couple of multinational MNEs to whom they export goods or services, or from whom they import very simple transactions, year on year, fixed margin kind of cost plus kind of arrangements. I think those would be the key beneficiaries of this concept. I don't think many companies which have complex transaction would go for this. Also, if you look at the fine print, if this results in reduction of tax liability, etc., that's really not, the assessing officer is not going to reject it. They're not allowed to approve this. So this is an option. You really need the assessing officer, or sorry, the transfer pricing officer to approve this. And you need to convince them that probably your business would remain the same year on year. In small, medium enterprises, there's also a risk when you go to the tax officer. In almost, as you and I, as practitioners of this subject know, we know most of the time at the assessment level, you are hit by tax demands. You tend to get relief at the higher levels. Now imagine get hit by a tax demand and trying to replicate it for the next 2 years also. So it comes with its own set of risk. Having said that, it looks like an interesting concept, but it has to be decided on a case-to-case basis, depending on the client requirement. Again, we are waiting for details on what would be the conditions which would be based on which the TPO would evaluate these requests.
I think rightly said, many points to analyze and look into before deciding whether people should go for this. Whether people can opt out. It's if taken for 1 year, what will happen to the next year? And if you have dynamic businesses where multiple services needs to be add on, how this entire thing will work. I think very relevant point. Now let me go to the next question, which is even more relevant and talk of the town on the cryptocurrency. How would the new crypto reporting framework impact crypto holders from India perspective, and what kind of insights the government is expecting to get from this? Because as you've seen from last 6 months or 3 months, there's a lot of been talk about people putting money into the cryptocurrencies and all. So looking forward to have your analysis on this.
Yeah, sure. So I think under the Indian G20 presidency, I think in New Delhi, India signed off, and a lot of other countries signed off on the automatic exchange of information for crypto transaction or virtual digital assets, whatever we might call them. Under that, it was required by countries, there was an obligation to exchange data on virtual digital assets held by their residents directly from government to government, between various governments. Now, India has brought in a framework in this budget where they have asked certain entities, which would be called reporting entities, to report transactions of cryptos. In India, we call it virtual digital assets, but anything which is done through a cryptographic means to the government by these reporting entities. It is not an obligation of crypto holders. It is obligation by reporting entities. In our sense, this would all be the intermediaries, the exchanges, etc. If in India, virtual digital assets can only be offered by platforms which are registered with FAIU. So all these registered platforms would be required to undergo this obligation on a specified periodic intervals. Interestingly, in our tax returns, there is kind of a gray area whether you really need to report it. We believe you need to report it once you are a HNI based on the thresholds. But on your capital gains, and when you are a small taxpayer, you really don't need to report anywhere. And the reporting only happens when you sell off the crypto assets because of the withholding obligation. With this, now the government gets to know who holds what, and everyone who is holding crypto assets would be required to that information would go from the exchange. This will help the government in trying to catch people who are probably not underreported. Having said that, this was brought in as a result of the signing of the automatic exchange of information for crypto assets, which has been done globally. So this information will also go to your to other countries if you are a non-resident. If this information, if you hold assets in an Indian exchange, we have seen cases where people have gifted transfer from their cold wallets to exchanges in India because they got a higher premium for selling it off. All those kind of transactions now really get reported. And it's interesting. I think this is a space where we are seeing it from 2016, a lot of flip-flops. Government really is not even banning it outright, but not even allowing it, but have made it very punitive and very difficult to transact with. But there are significant number of crypto players, crypto asset holders in India. So I think this will just make it the reporting more robust and can lead to notices coming in. We saw a lot of notices coming from ED also a couple of years back.
Thank you, Mr. Maheshwari. I'll come back to you. We have 2-3 more questions for you to address, but I'll go to my next panelist, Richa Sani, who's a chartered accountant with over 25 years experience in direct and international tax. She leads the direct tax technical division for Grant Thornton in India, as well as Richa is a fellow member of ICI and a cost accountant. She has vast experience in handling diverse and complex issues in DT, international tax, transaction advisory related matters for a varied set of clients across several sectors. And Richa has been looking into the budget very closely for multiple number of years. So Richa, before we come to the specific question which we have pointed towards you, you have anything to add on the TP block assessment or crypto which Amit has just spoke about?
So maybe I'll just add on to what Amit mentioned about the TP block assessment. I think one thing which again we are waiting more for the fine print to come in is what is that particular point of time where the assessee will be able to exercise this option. That is going to be critical. What the language seems to suggest is that it is at the time when the proceedings are going on. So whether at that time he will have that surety that this is going his way. So will that be the time, or is it after there is a draft assessment done on him and there is some indication of what it means? That is the point of time. So I think that is something that we'll closely monitor. The other is whether it is going to give you an arm's length price or a methodology which they'll approved, which is applicable for the next year. So I think these are the two things that which come to mind as of now, and maybe it's the fine print that will take care of these ambiguities.
Thanks. I think well spoken. Now come to my first question to you. Though we tried to ask Mr. Chopra, but he didn't talk much on that. So as you know, one of the major announcements by the finance minister has been that a new income tax bill will be introduced within this week. We are hearing 6th February is the date. While we have seen the earlier direct tax codes as well, which unfortunately could not see the light of the day. What are your expectations from the new bill?
Well, we've seen it all across the newspapers. The FM seemed to suggesting that this is a more progressive approach to taxation, and I think that is what we'll go by. We are hoping to see an act which is more in tune with times. The expectations as are being put across in the media and the FM herself are that this is going to be a short and concise piece of legislation. What the expectations is that these simple and short sentences are used. There are less number of provisos and explanations which make it difficult for a layperson to understand what the intent of law is. There is a lot of cross-referencing in the current act. So we hope that these cross-references are sort of done away with. She also mentioned that this is going to be this is much shorter version, maybe even half. So the assumption is that maybe the sections that are no longer in use will be taken out, and that should cut down the number of pages. There are certain areas where tables could be effectively used. So maybe this is time that we see some tables. It could be sections relating to return filing, say section 139. Sections relating to interest, which is 234 ABC, they could be put in form of tables. you could have exemptions, the Section 10 exemptions, the deduction chapter. Some of it may be coming in form of tables. The other bit is that there are a lot of issues on which Apex Court has laid down certain, there are certain judicial guidance which has been accepted by the department. So if that can pave way into the statute book, that will be a very a good sign to reduce litigation. The other is there are several terms which are not defined in the Act, where there is a lot of litigation happening. If those could then be defined and put in the Act, that is again an area where certainty and litigation will be reduced. We'll be looking at more presumptive tax regime, which again simplify the taxation for a whole lot of taxpayer, and compliances to be reduced significantly. But above all, what the stakeholders feel is that there should be adequate time which is given for consultations, considering this is a completely new legislation as against a comprehensive review which was being talked about. So though we hear that there will be some standing committee to which it is referred to, but there should be adequate time given to various stakeholders to put forth their suggestions on what is tabled before the Parliament.
I think many things I've tried to note most of the things which you just said, but before I come to you for the next question, let me ask Amit if Richa has missed on anything, because she's talked about progressive approach, an act which is in tunes with the times, simple and short sentences, lots of cross references has to be done away with. Assumption is it's more tabular, whether exemption section 10 exemptions or section 54, 234 ABC, more presumptive tax regime to be looked into, compliances to be reduced. I think if you have anything add which has not mentioned, because obviously the government will look into all these advice when they put for the larger industry and the chamber like us to look into and made the representation before it's put before Parliament.
So no, I think Richa covered it completely. Just a very different viewpoint. So I think it's going to be a bill, right? Obviously, like the Honorable Finance Minister has said, it's not going to be a draft consultation. The sense is it's just more about simplification rather than bringing some big changes or change in the concepts. So on that, I think there were a lot of things which really were needed. One was, I mean, if really we could have had a concept of group tax returns, or a lot of unnecessary restructuring, demerger, mergers, especially we have the provision right now, the budget change. I think a lot of that was not required. Probably risk-based audits, again, really need of the hour, should not be based on thresholds. How much revenue can the government generate? Especially it's very relevant for transfer pricing. Then the tax officers have no accountability. I think that's a big issue. That's why we have these high-pitched assessments get thrown out in the court a lot of times. No implications. I think that's something which is required. And residential status, as Akhil, as you know, I think probably too complicated. R and OR and stuff. Really need to simplify that. And probably one more thing, I think we all know everyone talks about P, but really no clarity on how do you attribute profits to a P, right? The draft report remains draft. This sword hanging on all of us, all our clients. So I do not expect this to come out in this new code, because of the fact that I don't think it's going to be anything substantial. It's more about how do they simplify it. And probably after a couple of iterations or a couple of years, we might see these kind of concepts coming in. But a lot of them are based on global best practices and should be there.
I understand about 6,500 suggestions have been received. So it will be a big task for the department to, sieve them through and get hold of what is only simplification and what is, truly transformation to something to bring in new concepts.
I agree with you, Richa, and I think the points which Amit just picked it up with are very much, it's a transformation which is required, whether it's a P, residential status, accountability is a big name, though though Mr. Chopra also talked about accountability, that the department and the revenue is very much accountable, but he must be talking about the bureaucrat and people at his level. But you rightly said, we need to have and the very unique concept of group tax return. Let's hope that we're able to table few of the thoughts. But you said it's a bill, it's not a draft communication. Yes, you're right, but still, I think they're very much uh, okay to take any suggestions still. So, Richa, my second question to you, as you've seen, the government has made some attempts to rationalize the TDS provisions in the last budget as well. We see the same trend being followed by the government in the current budget as well. Obviously, moving towards the theme of making more things more simpler before the new tax bill is tabled. Uh, we request your insights on the measures taken by the government to rationalize and simplify the TDS and TCS provision to meet its objective of ease of doing business in India, or still there's a long journey to it?
Yeah, Akhil, as you rightly mentioned, they have carried forward, the path that they took last year for rationalization. So there are quite a few changes which have been carried out this year. To begin with, first and foremost is the increase in the thresholds, and that's happened in many cases. And there are reduction in some rates as well. So if we were to see, there have been instances where some thresholds have actually been doubled. And that would be in the case of, say, dividend or interest paid to senior citizens. In some cases, the thresholds which were applicable for the entire year have actually now been converted to transaction level thresholds. And that's been in the case of, say, winning of horse races, lotteries, etc., the windfall sort of incomes. On the TCS fronts, I think the key ones have been that there has been an increase in the threshold for remittance under the LRS from 7 lakh to 10 lakh. That will bring relief to a lot of taxpayers. And TCS on remittance for education, but which is funded through a loan from specified institution. And though that in specified institution alone is something where that 0.5% TCS has gone away. In all the other cases, the other provisions with the upper threshold of 10 lakh will now continue to be there. This definitely has leads to a reduction in the compliance burden for taxpayers, and obviously the cash flow issues in many cases get sorted out. Now, secondly, another big change has been on the decriminalization front. Now, there has been an exemption from prosecution in TCS cases where the tax is paid, tax collected is paid to the coffers of the government before the due date of filing of the return, the TCS return. So this is again in sync with what had happened for TDS last year. But again, it's important to note that this is only a limited decriminalization. It's not a complete decriminalization. It is applicable in certain circumstances only where the tax is paid before the due date. Thirdly, the higher rate of tax, the TDS and the TCS, which was there for non-filers of return of income, that has been done away with. It was being felt that that's created a lot of problems for the deductors as well as collectors, because they were finding it difficult to verify whether these returns have been filed or not. And in many cases, on a pessimistic basis or just to safeguard their own interest, higher deductions were being made. So this was resulting in, of course, higher compliance, more compliance, and blocking of funds. So this has been done away with. However, the higher deduction for non-PAN or the invalid PAN cases, that continues to be there. Fourth is that currently there was an overlap of TDS and TCS in certain situations of sale and purchase of goods, where the quantum was in excess of 50 lakhs. The rate, of course, was 0.1%, but there was always an ambiguity as to who is going to take care of this responsibility. The government had earlier clarified that if once TDS is done, then TCS is not required to be done. But again, that required a lot of coordination between the buyers and the sellers to figure out that whether who's taken care of this responsibility or not. So this is something which they have addressed now. because what came to light was in that multiple cases, double deductions were being done, both by the on the TDS front and the TCS front. So TCS provisions to that aspect have now been scrapped. Yes, but there is a lot more that is there on the wish list. The number of rates, they still continue to be on the larger side. What stakeholders have been representing and asking for is that maybe the rates could be limited to just 2 or 3 rates, so that there is no litigation on account of rates on the classification and the subsequent rates. There was also an anticipation that wherever there is a minuscule collection of tax in any particular section, that could be removed. So that maybe we'll hope for in the upcoming bill, or they could be clubbed together so that, you know, that simplification agenda is carried forward. Also, the requirement for TDS certificates, which seem to be redundant now, since most data is available on the system itself through 26AS. That is again a simplification maybe we look forward to in the upcoming bill. And on the top of the wish list perhaps is the TDS ledger, something akin to a GST ledger, so that those matching exercises that have to be done, taking into account the income and the related TDS, and takes a lot of time for the taxpayers, that is mitigated to some extent.
I think fair summary. You've given all the points which people are looking for, and looking into your response, it looks very positive. I'll come back to you, Richa. Now I have to go to Amit and Sandeep from AKM Global. My next question is you know, to the biggest announcement which has happened. The government has provided substantial expansion of the slabs and tax rates under the new tax regime. However, there is no change in the old tax regime. What are your thoughts on the government's intention to phase out the old tax regime? As we've seen, you know, in the last you know, tax year, which is assessment year 24-25, 72% of the people have filed their tax returns. Individual taxpayers have filed their tax returns under the new tax regime, which is a big number. And with this amendment, do you think that 72% will become a 90%? But after the proposed you know, changes in the new tax regime, do you still feel that, you know, some people will have old tax regime, or will follow old tax regime, and you know, because there's certain deductions, exemptions which are still available under the old tax regime? Just wanted to have your perspective on this overall scheme of things.
Yeah, Akhil, this question is for me. I'm sorry, I just got dropped off between.
This is for you or Richa, whosoever wants to pick it.
I just got dropped off. So if I
Yeah.
understand correctly, I think your question is more about how many, I mean, with the new changes, would people go more towards the new regime, right? And if
New regime,
right,
new
okay.
regime.
So I think, Akhil, I think the intention of the government, as they said when they introduced this new regime, also was that they wanted to get rid of the exemptions, simplify the tax structure, and make it more easier for a common man to be compliant with the tax law. That was the very clear-cut objective when when the new regime was introduced. Not to give a shock, or let's say to probably allay concerns of people, they gave an option to go with the old regime as well, so that people who had legacy investments, tax saving instruments, they were able to continue with that. Now, the government does not want tax to be a tool to encourage financial investments, which already there is a fair bit of penetration barring insurance. So I think it is very clear now that the government wants to to promote the new regime, which is simpler to manage, and do not want to promote financial products by giving tax breaks. Now, this change which has happened obviously makes a very big difference, and people who, especially the millennials, Gen Z, who are not investing a lot in the traditional legacy instruments like life insurance, ULIPs, etc., or probably staying with their parents' house, I think this new regime makes a lot of sense. Of course, I believe 72% would become 90%. There would be very few people going with low regimes. And now with these changes, I think the incentive to do all those investments have dramatically decreased. So I think that's going to happen. That's what the government is also promoting. You can expect all kind of reliefs happening in the new regime only, reduction in tax rate, but nothing really happening for the in the old regime, which happened. And as we know, there is this the 12 lakh limit. I don't want to. I think everyone knows that. But yeah, so I think new regime makes a lot of sense for many people, unless people have some really legacy investments, etc., which they really can't get out of. But even there, it has to be very substantial investments to make sense.
No, I absolutely agree and echo with you because that's a theme. 2020 is the first year when the government has come out with a new tax regime, and in the 5 years we've seen the shift to 72% of the people. And this year, as you and me, everyone on the call agree that 90% of the people, and especially in the beginning of their career, if they get 12 lakhs as a tax free, and there's substantial benefit coming in, and anyways, the young generation is more on the liquidity, and we've seen how the markets has been striving in the last 4 years, people infusing a lot of money, a lot of new players are coming in the stock market. So overall, I think the things have been changing. It's not like a traditional way of saving, investing, and saving the taxes. Still, government is not saying that you should not save, you should not invest, and you should not have LICs and other instruments where the investments goes into. But this is the different way of giving more liquidity and push to the direct consumption. My last question to you, Amit and Sandeep. The government has increased the window to file an updated tax return till 4 years from the end of relevant assessment year, as you've seen. However, when we do the fine reading of the provision, it indicates that there's a corresponding liability attached to it of 60% and 70% of the additional tax on additional income, disclosed is payable when the return is filed up to 36 months or 4 years for that matter. Do you anticipate that taking this opportunity to file updated tax return, given the high rate of additional taxes for the year 3 and 4, though our honorable finance minister said that 90 lakh of 90,000 or 90 lakh, I don't remember the exact numbers in the speech. She just spoke about that 90 lakh people have taken the benefit of updated tax return, and we want to extend it further.
Yeah. So Akhil, just before I answer that, very quick comment, since I got dropped off, I'm not able to see the audience questions because since the Q&A, I think there were a couple of questions on indirect taxes also. So we might take it later on once Richa is done. So my partner Sandeep would be able to take care of those questions. So coming to your question, Akhil, I think obviously in India, people do once this concept started of updating tax return, people wanted to come clean. You get sometimes your AIS information in your tax portals get updated later. People who are probably not aware of those incomes get to know that. So I think it's a good facility. It has found takers, but kind of in the third, fourth year, I think the numbers would dramatically reduce in terms of people who would come and file the updated return. There would be some very peculiar cases, because if you really have caught out what you missed, you at best get to know it in the next year return or next year return. We saw a lot of cases of undisclosed foreign assets, ESOPs, so many compliances have happened. But as you know, people usually catch it up in the next year. So I think the third, fourth year, the tax rate 60-70% is pretty high. It's very punitive. Having said that, having an option instead of no option is always good. People who probably have to file a tax return to get a home loan, they want to show 3 years of return of income. Maybe those people get benefited. Again, where you have, but one thing to note is, I think after third year, if you have a 148A notice, you are not allowed to file an updated return unless the notice issue gets quashed. So as I said, I believe there would be limited takers. I don't know, probably I will ask Richa also to comment. I don't think that it would be a real game changer, but again, having an option instead of no option is really good. In fact, like under the Black Money Act, I think a lot of us want another window where people can really come clean and have, if we can have something like this, would be very appreciative. So I think this is good, but don't see many takers or being a real game changer. Richa, please, if you want to add.
Yeah, I absolutely agree with your analysis on this. Yes, it's a good to have provision for certain situations, certain peculiar situation, but the additional taxes are really on the very higher side. So again, there might be a limited use case to it.
And a lot of people will just simply say, I will just take my chances, right? I mean, after 3-4 years, I think it's a bit difficult. Anyways, I think let's see. I'm sure it would be a good move.
Because if the government has some numbers and they believe that, the trust is the theme also, which our finance minister said.
Right,
and they said it's a both way. It should not be the one way. So let's see. But as you rightly said, the additional liability of 60 to 70% is very steep. That's something to make a note about this. Now coming to my last question to you, Richa. The government has proposed to specifically exclude NRs who purchase goods in India for the purpose of export from the applicability of SCP provisions. What are your thoughts on this, and what more can be expected from the government in relation to the SCP provisions?
So, well, SCP provisions are typically applicable in a case where there is no tax treaty, or in a treaty situation where the taxpayer for any reason is not able to take benefit of the tax treaty. And it has in the past expanded the business connection definition. So what has now been done is that there is a limited leeway given, or a limited benefit given, which is ideally to make it in sync with the business connection export carve-out. So only in those cases, activities of non-residents which are confined to purchase of goods in India for the purpose of export, they will be out of the purview of this expanded definition of business connection, which has come in through SEP. However, what the stakeholders were actually anticipating was that maybe a more wider exemption is given. See, when this provision was actually brought in, it was on account of the Action Plan 1 of OECD, where they were trying to target digital businesses because of the tax challenges which different jurisdiction had in taxing those digital businesses. So this was typically meant to tax only digital businesses. However, the way it is worded, it is very expansive and it can cover all sorts of businesses. So even somebody who's importing, in a situation of even import of goods can get covered. There are certain thresholds in terms of revenue and the users, which also are considered by taxpayers to be on the lower side. But even leaving that aside, what was being anticipated that there'll be a clear-cut direction that this is only pertaining to digital goods, as was the thought process by OECD when they propagated this solution to taxation of digital businesses. But that has not come in actually. And the other thing that was being anticipated was that there'll be some sort of rules which will come for attribution for SCP sort of businesses. There was some time several years ago where some draft rules were shared, which gave certain proportions to various aspects that get captured in an SCP calculation, but they were not finalized and they could never be released. So that is some anticipation that we still have, that maybe that is something that the government will consider. Also, these are applicable from assessment year 26-27. So the ambiguity as far as the earlier years still continues. Anything that you would like to add further on that?
Amit, yeah, you want to add something?
No, I think I'm good. I think fair comments, and probably, yeah, but not a very, very relevant provision considering if you're coming from a treaty, like you rightly said. So I think limited applicability, but yeah, just to make it streamline, I think it's good, and yeah, for some countries, we really face challenges when complying with this.
Thank you both of you. And before I'll conclude today's session, I will go to the Q&A. Just wanted to ask last thing from both of you. Do you think any hits and misses from this budget? Amit first, you can go, and Richa, you can. There are misses or hits from this budget.
I'll just probably make a couple of quick points. So one is it's just my personal opinion. I was probably expecting a lot substantial reforms to considering the kind of tariff threat we are facing. The budget has done a lot for consumption, I think, but I think what we really need is animal spirits in our businesses. So manufacturing rate did not get extended. The concessional rate of manufacturing did not get extended. I think TDS definitely, obviously it was rationalized, but still too many complications. TCS, it's more of tracking. Do you really need a 20% TCS for tracking purposes? It really burdens people. And I think what we saw with DeepSeek, what China is doing as moving high in the value chain, I think R&D is very important for India. Our share of R&D as a percentage of GDP is very less. Private sector is very afraid to do R&D. If projects fail, a lot of our investigative agencies hound the businesses. So I think R&D is what we need to focus on. So was really expecting something in the budget. And yeah, I think probably no change in the corporate tax rate or LLP rate. Probably they could have made LLP more attractive. There is a differential between a tax rate for companies versus LLPs. So I think a lot for small, medium businesses, LLP still works well. It could have made a lot of difference. But otherwise, it's a great budget. I think it's a good budget, and hopefully our economy would withstand these storms. A lot of unexpected turbulence coming from US.
Thanks, Amit. And Richa, anything from your side? Because when I see that the government has not touched on inheritance tax, has not touched on capital gain, has not touched on wealth tax, because in UK we've seen there's inheritance tax which has brought in, and people were fearing whether this will come in India as well. So I think this is a thumbs up and a positive sign, and it's a good miss by the government, if I can say that. You're on mute. You're on mute.
Yeah, absolutely. And but I think for me there have been quite a few things to I'd say in the hits category. I think that the overall key theme of deregulation and ease of doing business, maybe we are taking right steps towards that. The new income tax bill that's taking shape. That's again something very on the positive note. The rejig in the personal tax rates and the slabs, which is likely to provide a boost to the consumption and investment. And the way that the slabs have been tinkered, there is something for everyone in it, whoever opts for that regime. The rationalization of TDS and TCS in steps in the right direction, but yet there is a lot more that can be done here, and we'll expect the new bill to take care of it. The benefit for startups that was extended by 5 years, that's a really good move. And as Mr. Chopra rightly mentioned, that that we've always been asking the government, don't do it for 1 year or 2 years. So they've really heard it and made it a 5-year extension. That gives a lot of tax certainty to businesses. On the miss side, I think though the benefit for the manufacturing companies expired last year, but there was a hope that to give boost to the Make in India, and of course the fact that the manufacturing companies do have in past created a lot of employment for the country, and considering the demographic situation India is in right now, maybe that could have been extended. So that is something where there still was an anticipation which possibly is missed out.
I think very well summarized. Just one thing which I believe the government should have come out with something on the EV, electronic vehicles, because the focus is very much, and people The government wants to, because you know that till 2023 there was a deduction of 1.5 lakhs which was allowed to the individual taxpayers. The government should have looked into that. This for there was a lot of expectation, and even increasing that limit, because the way EVs cost is on the higher side. So I think thanks everyone. I think we had a good 1 hour 50 minutes engaging discussion. Uh, Overall, we can say that it's a commendable budget which tries to strike a right balance between Indian growth sustainably, uh, be it at a fiscal prudence, structural reforms, employment generation, and most important, revival in domestic consumption. This is a theme with which I want to conclude, and on behalf of Indian American Chamber of Commerce, I want to thank each and everyone. Be our esteemed panel or participants to have such an engaging session. There are few questions. One question I believe that from our IDD side, I just lead that, and Sandeep can quickly say. Sandeep, one of the participants asked that being an exporter in 24-25, we have got more import orders than export orders. How about this year? What's the plan of Indian government to smoothen the process of export from here?
Yeah, so Akhil, I think this question is more from an economy perspective.
Yeah.
So I'm not the expert in economy, so I think maybe Gaurav would be the best person to answer this.
Yeah, Gaurav has already answered this, but yeah, Gaurav, you want to throw some light?
No, I think a bit of rebalancing definitely has to happen with the rupee depreciating. I think they have reduced a bit of tariff for intermediate goods as well, so that we can plug into supply chains. I think the exports being low was also because of inventory effect in the US, which is a major importer of goods overall, and I think that has kind of started waning off. So hopefully going forward with India getting into electronic supply chains, people like Apple coming in manufacturing here. Of course, the value addition continues to increase year to year in terms of their supply chains also coming in here. So I think it's an important factor because government needs to have export as one of the priorities to make sure that the GDP growth is also held by that part. We do think that given the US, if it doesn't do anything different from a tariff perspective, because if they continue to put tariffs, their economy also gets impacted. That might be something as a risk that on the horizon from an export perspective. But also what happened was because of Indian economy growing faster in last year, the imports also pick up because our consumption goes up. So I think those were the few reasons. I do think going forward that some sort of balance should come in.
I just
Thanks,
have one
Gaurav.
quick comment. Say that Mr. Trump coming in, I think the best days of global commerce are probably behind us. It would be a lot of protectionism, a lot of allegation, tariffs, counter tariffs. I just believe that uh, India should focus a lot also on the domestic economy or make reforms on the, especially on supply chain and others. Just one, that was my quick comment. Akhil, if you don't mind, I think there was one question on safari retreats. Again, I'm not able to see that, but one person had put in a question asking on the amendment or the retrospective amendment to nullify safari retreats. I think that was one important thing in indirect taxes which came in. So we really wanted to address that because we thought we'll do it at this point of time. So
No, I think fairly said, and more than that, whatever key, because we should take an advantage of Sandeep being on the panel today. He's been kind enough, and he can throw light on the key updates from a GST perspective, because our participants would love to hear that.
Yeah, Sandeep, if you can read that, I don't see the question because I got logged off. So if you can just
Yeah,
address that question and probably then give a background about something about the indirect taxes, some key provisions. Thanks.
sure. Yeah, thank you. So I think the question with respect to safari retreat is with respect to the retrospective amendment under section 17(5). So I think the in the if I talk about the specifically about the context of safari retreat, I don't think this judgment would have any further implication because the thing is the provisions of 75 make it clear that if you are not doing any value addition for these kind of things, then you cannot take credit for these. And in the question of Safari retreat, the matter was primarily related to the interpretation between the difference of the wordings plant or machinery or plant and machinery. So I think the Safari retreat judgment basically stands nullified with this particular amendment, which I believe is something which is kind of a downside from the construction infrastructure industry as such. See, I would also talk about the other hits and misses under the GST or the indirect tax provisions per se. So there have been some procedural changes which have been brought under the GST regime. And some of these we have seen in the past that the government is trying to put the onus on the taxpayers themselves whenever it comes to availment of the input tax credit. So for example, they have changed the provision respect to the claim of input tax credit with respect to the credit note. So to take a scenario, if I have issued a credit note against my own invoice, typically I would be reversing the GST on that and I would be taking the benefit of for my own output GST liability. But there used to be scenario where the customer may not have uh, reversed the credit on their side. So now the thing is that they have put the onus on me now to talk to the customer and tell them to reverse the credit. And if they don't reverse it, then I would not be able to reduce it from my own output liability. And this is something which we anyway see under the ITC provisions that the credit is required to be taken. I mean, the payment is to be made within 180 days. So basically, they want the vendors and the customers to talk to each other and don't get into between the allowing the credit to any one of them. I think the other one positive aspect is related to the treatment of the vouchers. I think this voucher issue actually created a lot of controversies under the GST laws. So you had this classification PIP, non-PIP vouchers. So now that is something which has been done away with, which means that if you buy a voucher from any particular website, or let's say even if you buy it from a gaming website or a gaming portal, you will be required to pay GST only when this voucher is redeemed. So now the earlier question was whether you could realize the voucher really at the time of buying of that voucher itself or not. All those questions now goes away. And this is something I think which is welcome, and they have really simplified this particular regime. The other thing is that in the ITC reconciliation, this is also something very procedural, wherein all the credits reflecting on the IMS portal, you are basically required to either accept or reject all the credits available there. And if you don't do that, you will not be able to file your GSTR 3B. So which basically means that if there are any ITC invoices reflected in your IMS portal, then you need to cross-check all of them. And you cannot take a proportional or provisional credit as of today. When you cannot do this exercise, you cannot keep this exercise for later on. You will need to do all this today, and then only you will be able to pay the liability and avail all the necessary ITC. So I think these are some of the important amendments which have been brought under the GST. I think I give this back to Akhil.
Yeah, Sandeep, can I make a quick comment?
Yeah, sure.
Is it fair to say that India has reduced tariffs on a lot of items to be optically seen as a low tariff country?
Yeah. Yes. I mean, if you talk about
in
auto
front of
parts,
President Trump.
Yes. So for example,
So in general, we have done a lot of rationalization
Right.
of tariffs, right? So there are a lot of
Right.
tariffs we can't go in detail, but a lot of reduction of tariffs have happened. And I think in
Right.
customs, there is one provision on the provisional assessment. I think that's I thought was probably can help a lot of companies.
Sure. So
With this, Akhil, probably don't want to get into too many details, but I think Safari retreat was one question which somebody asked. And I think there was one more question on presumptive taxation, if I remember correctly.
yes.
So Sandeep, you want to answer that? Just
So the
last
question,
question probably,
sure.
and then we go.
So the question really is, someone asked was whether, this new regime of 44 BBD, where they have brought in presumptive regime for the electronic support for the electronic manufacturing industry for the non-residents. So I think somebody asked whether this would apply even if these services are offshore. I think the answer is yes. The provision doesn't ask anywhere that there has necessarily to be a PE in India. And notwithstanding, I think whatever is provided in the treaty, I think, I mean, the treaty rate is lower, but I think in this, the kind of tax rate that they have proposed, I think in most scenarios, this tax rate would turn out to be beneficial more than the treaty. And the other question was related to whether someone can avail the provisions of 44DA when you have a PE in India. So I think provision doesn't contain any bar as such that 44DA provision with respect to the professional services cannot be availed in such a scenario. In my humble view, I think this is something which is possible. The only there are a few questions relevant whether the kind of support that is being provided under the 44 BD, can this be really classified as professional services under 44DA? I think that is one relevant question that needs to be answered. And after that, I think I mean, one can choose any of these provisions for the purpose of tax treatment.
With this, Akhil, I think we are on time. Just wanted to make sure that we answer all audience question. I don't know if there are other questions which Richa would probably like to address, but I'm just not able to see the question. Sorry about that. I just saw one. I replied immediately. Sorry about that.
No, I think there are not many questions, but thank you. Once again on behalf of the Indian American Chamber of Commerce, I would like to thank each and every panelist, Amit, Richa, Gaurav, Sandeep. Thanks for your time. More than a time, thanks for the insights you've given to the industry at large, the perspective you've given to, and a lot of expectations. I wish Mr. Chopra should have listened to us till the end, but looking into his time and everything, it was a good panel. We've talked about taxes. We talked about equity market. We talked about fiscal deficit. We talked about RBI measures to make stronger to make our currency stronger. We've talked about GST provisions as well, and India US relationship corridor, everything. And we are on time. I never thought that we will be able to use this 2 hours. I thought we will be able to finish in 1.5 hours, but thanks for having you once again, and let's see what's there on 6th of February in new tax bill. Thank you.
Thanks a lot. Thank you.
Thank you.
Thanks
Thank you.
everyone.
Thank
you,
you so
everyone.
much. Thanks.